Good morning, traders. Welcome to your 7-minute market update, utilizing technical analysis to predict direction based on human emotion. Today is March 10th, 2013. Lots to talk about, but not really. So let's get started. All right, so this is a chart of the SPY, which is the ETF that tracks the S&P 500. I'm going to make this video as fast as possible, but this time hopefully I'm serious, but sorry I didn't release the video yesterday. I was in the hospital doing blood work yesterday, so I didn't really have time. And after that, I had to kind of take a rest and a breather yesterday. So anyways, I'm gonna push this video out as fast as I possibly can. Lots of interesting action in the previous weeks. So I'm going to start from this candle over here, which was February 26th. We had this reversal candle here, which was not a reversal signal in my opinion, but it obviously was. And it came all the way up and it continued higher. It went right into this double top here and gapped over it. That signaled a potential of it going even higher, and it sure enough did. Now the cool thing about all of this is that even though I do these specialized calculations that as far as to my knowledge nobody else has out there, even the regular analysis support and resistance lines still hold up. I mean, I had a resistance line here, okay, indicating from this pivot to this pivot point. And if I just zoom in here, you can kind of see intraday we had resistance there. The next day we actually had another resistance point there, and again the day after, which is Thursday, another intraday resistance point, and then Friday we break through to the top. In addition to that, while working with the mathematical calculations, we have this 154.10 level here, which I told you guys in the previous video to not or to disregard because we got close to it. I mean, I know I discussed in the previous video, if you draw a line from here to here, these calculations, they work, but they're not 100% accurate. For those of you who've been watching these videos, sometimes they're very accurate and sometimes they're just a little off. In any case, if I draw a line there and I put it here, you could have taken the trade to the long side here and would have made money there. So, it's just these calculations, when they are off, they're symmetrical, okay? But because of the symmetricality, if that's even a word, it basically means that we've already come close to hitting this level already, which is the 154.10. And as you all know, once one of my mathematically calculated levels are hit, either it be resistance or support, it's no longer as strong anymore, and therefore I would not take trade based off of that alone. Or I never do it. I never take a trade based on that alone anyway. But it doesn't hold as much water as it would normally hold had it not have come this close to hitting this level. Okay, so we come all the way down into this 149.51, blah blah blah. Again, all the way up into now. We passed the 154.10 simply because it's already been used here, and the next resistance point would have been the 155.44, which is exactly what we're in today. Friday has closed at 155.44. A perfect, so sometimes it works good and sometimes it doesn't. However, okay, here's the tricky part. Unfortunately for me, because I have a full-time job, and sometimes I'm sure all of you do too, at the very last minute, it met my requirement to actually initiate another short. Now you guys all know from my previous videos that I've been shorting this market. Short, break even, short, break even, stop. So basically I've been shorting the market and I've been stopped out, break even. That's how I play the market. I short the market, it goes in my direction intraday, and it goes against me because of the federal manipulation. And that's how you beat the federal manipulation. You put a break-even stop, it stops you out break-even, so it's like you never entered the market to begin with. This is the only time that I did not initiate a short trade, and I might actually miss a nice pullback, but we'll see. I mean, to be honest, I'm going to show you something a little later in this video that's going to be pretty interesting. So yeah, I did miss this trade, and I could have it's right on the 155.44, but I'll tell you why it's kind of contradicting. It's not a solid short trade in my opinion, okay? And ever since gee, I don't know what day it was, but for a very long time, the market has not met any of my requirements specifically to short. And what are my requirements? You guys, especially Freddie out there, or Favco 2010, you guys know, who's been following me for a while, there's just a few things that I look at. Obviously, we need to be in some sort of supportive resistance, whether it be my mathematically calculated level. Okay, mathematically drawn, it would be a Fibonacci retracement, it'd be pivot points, it'd be gap fills, gap windows, some sort of resistance and support level. Now, multiple support and resistance levels always hold a little bit more water, especially trend lines. I like trend lines a lot, but it helps especially when it lands right on a mathematical calculated level. Mathematical calculated level, for you those who are new, are these pink lines here and these yellow lines here, of which are a mathematical calculation that I invented in December of 2011. Okay, which means I have not released this calculation to anybody out there except for on this video here. The actual calculation I will never release, but the support and resistance lines are something that I'm going to put on these videos. In any case, that's the first thing. The second thing is I need a reversal candle, some kind of doji candle, some kind of shooting star candle, some kind of engulfing candle. Or pattern, I should say. And those are the only three that I really like a lot. The doji, which is not as strong but I like. The shooting star, which is my favorite. The shooting stars, or the opposite end would be the hammers. And if you guys are curious about those patterns, those are single candle patterns that you can search on Google for. And of course, the engulfing patterns. I like the engulfing patterns a lot, but the hard part about engulfing patterns are that the move has already been made. If the move has already been made, you don't make as much either up or down. Okay, so that again is my favorite, is the shooting star pattern. All right, so that's the second thing. The third thing is it must be done on volume. You guys always hear me give you the eBay scenario. If you want me to explain the eBay scenario, if you're new to these videos for next week, just post in the comments saying, what is that? What are you talking about as far as that goes in volume? Okay. The fourth thing is that it needs to be in a consecutive move for 3 days, meaning 3 days up, 3 days down. So after the pivot, you need 3 days up or 3 days down for that to be considered a pivot. Obviously, in this scenario here, we have multiple days going straight up, so that meets that rule as well. And then, of course, the volume, speaking of volume one more time, needs to be higher than the previous 3 days. It's pretty logical. If you're going to have at least 3 days to make a pivot point, you're going to need at least 3 days for the volume to be higher than the last. I'm sorry. You're going to need the volume to be higher than the last previous days. That only make last previous 3 days. That only makes sense. So there's not very many requirements that I do have, but these requirements keep me in check, to keep me safe. Or if I want to venture into initiating shorts like I have previously been doing, then be very careful. Put your break-even stops in there and don't get greedy. And that's why I put in my short trade. I get stopped out break even. And when I say stopped out break even, it means I enter in at say $10. It goes down to, say, as a short trade, it goes down to say $9.90, and then boom, it closes at the end of the day at $10.50. Well, on its way to the $10.50, it stops me out at $10. I include the commission, of course, and I get stopped out break even. I lose absolutely no money, and I let the markets do whatever it wants. I let the federal government do whatever they want as far as destroying the dollar, and I'll get to the dollar a little later, anyways. So, what does this all mean? Why am I telling you guys all of this? Well, it's simple. We have a doji candle here. We close right on 155.44, which is a mathematically calculated resistance level. We barely pierced this upper trend line here, which I don't necessarily like, but we have not validated this move, meaning we didn't close the next day above here, which would be Monday. But this would be a legitimate short trade. Why? Because we also have it on higher volume. Why do I think this is contradicting? I just said earlier in the video that yeah, it does meet my standards, but it could be still contradicting. Well, here's one thing. The volume we closed on Friday was 123 million. The volume we closed, which is the highest for the past 3 previous days, was 121. So we only closed 2 million more than we did to meet the requirement. So it's barely high. So yes, on a technical level, I met my requirement on Friday. It closed higher than the previous 3 days. We have a reversal candle in resistance, which is a mathematically calculated level. Now the resistance point isn't as nice as I'd like it to be, but let's just double check on that. All right, actually, I'm wrong. I was just trying to justify missing this trade, and I'm kicking myself right now because I missed this trade. But I have to be patient, and that's the whole thing about trading. I'm gonna extend this line. You just saw me extend this 155.44. I extended it all the way to the left, and I'm not gonna save it. But the reason why some of these lines, if you're new, some are short and some are long, is it's so you guys know when I actually made this calculation. This calculation was done on this day here, which was February 1st. This calculation was done here, which was January 3rd. Just so you guys know when these calculations were made, just so you guys, can see that, I'm not trying to say, oh, make a mathematical calculation after the move has already been made. If you look at my previous videos, this 155.44 and the 157 has been there for a while. Okay, now I'm going to zoom out here. And that pink line, the only one that you see that's super long over there, we're just going to zoom out to see if there's any other resistance point, and there you have it right here. The 155.40, we've had this pivot point here, so this is a perfect pivot point here. We're right into some resistance here, and this is a very nice, beautiful pivot point here. So potentially, we could actually see a reversal or some sort of small pullback already happen. So let me just load my savings. So there we go. I made this level on this day here, which was January 23rd. In any case, the markets could see a slight pullback soon, but just keep in mind that there's a possibility that the federal government might start manipulating the dollar to bring the market higher. So that's just something that remains to be seen. Now, why is it contradicting? Let me show you. This is the 10-minute chart of the SPY. Okay, as you can see, this is Friday. As soon as it went into the 155.44, on the intraday, you could have taken a short trade and you would have made very nice money. And the short trade would have been from 155.44. Obviously, that's when you would have taken the trade, and it went all the way down to 154.66. And if you had bought the ITM or in the money puts, like way in the money puts for a day trade, that would have been a clean cut, a few grand right there. We float higher right into almost back into the 155.44. We don't quite get there. We come back down into this support level. We go all the way back up again into the 155.44, and we have a 1 minute pullback. If you looked at the 1 minute chart, that's what you would see right there. Because this is the 10-minute. We break through and then we come down and close right on the 155.44 level. What does that tell me? That tells me we didn't close below the 155.44, and we didn't close above the 155.44. We closed right on the 155.44. So this could potentially mean we went right into 155.44 and we could get a bounce. You see how it's now support? This was resistance. We break through it, and now it comes down into support. So that's the 10-minute chart, and we all know that the daily and the weekly will supersede or will trump the 10-minute or the 1 hour chart. But it's just something to consider. I think I'm just justifying the fact that I missed this trade, and it really kind of bothers me. Anyways, to make a long story short, my ultimate trade, and I've said this in the previous video, and this is the one that I want to show you, is the 157 level. Okay, the 157 level, I mean, I don't know if we're going to reverse here, but if we do, so be it. I'm just going to have to wait to pull the long trade trigger if I do see a long trade initiation, possibility. But on a technical level, as a technical trader, not a fundamentalist, technical trader, we have a reversal. It is in resistance. We have volume that is higher than the past 3 previous days, even though it wasn't very much. This constitutes a short, in my opinion. Would I take a short now? No, because it's too late. Again, for me, it's one of those things. I'd be chasing if I take a short now. If we float up on Monday, we go higher on Monday, then yeah, then maybe I'm gonna initiate a short trade because the 157 is just lurking right there. It's only $1.50 away from the 155.44. Why is the 157 such a good level for me to see? Let me just zoom out one more time. I know I said I was going to make this video short, but this is very important data, so maybe I might not do that. This video might not be as short as I expected. Lots to talk about. Alright, I'm going to delete auto drawings. This is the weekly chart of the SPY. I'm going to let me just zoom out. Okay, let's just get let's get something here that says 157. Let's just grab a price level. Let's extend this all the way to the left, and let me just edit this. And we set this to 157 even, because that is actually the mathematically calculated level, which is the 157 even. It's not quite there yet, but it's almost there. But I'm going to zoom all the way out here, and look at that. Bam. Right on the tip of this guy here. The high of this week was 157.52. Okay. So at 157, I'll take a short trade. At 152 is the let me just get a different drawing tool here. 157.52 is the 2007 year high, which was the year that everybody thought that the economy crashed in 2008. If I talk to anybody that I work with, oh, 2008 was when the market started crashing. No, the market started crashing in 2007. It's obvious. We see it right here. It was from 2007. Okay, the 2007 high, right? The 2007 high was the bubble burst at 157.52. Okay, so that's going to be a significant number, in my opinion, for at least, if not anything, a pretty substantial pullback. Let me zoom out one more time, and bam, what is this? This week here was the high was 155.75, which was $1.50, which is pretty much what we're in right now. But the 155.75 is another resistance point from back in the year 2000. Now here's the interesting part. Let's see, 2000 to 2007. We'll just grab from this point to this point here. I don't know if this is going to work or not, but let's just try and see what happens. Oh, and then now we're just going to put it from this point. Let's see how much further we have. Actually, there's quite a bit more to go. It's not as symmetrical as I thought it would be. Anyways, scratch that. But to make a long story short, we are into pretty close, pretty strong resistance, okay? So if you're long, put in your stops. Just remember that, because this guy might come crashing down pretty soon. I mean, just looking at the weekly chart, I mean, I might actually still initiate a short trade on Monday. Anyways, let's get moving. All right, this is the daily chart of the UUP. Now, normally I do the dollar futures, but for whatever reason, the dollar futures chart isn't really working for me today, right now. But the UUP will definitely suffice. The UUP is the US dollar, and as you all know, the dollar is inverse to the markets. When the federal government likes to print money, devalues the dollar, and the markets go higher. That is just how it is. So let's do a quick analysis on this. I'm not going to have any mathematical calculations for this, simply because we don't need it. Why? Because we are into a lot of resistance points here. We have gap fills, gap windows, we have pivot points, we have a lot of consolidation right over here. We are into a lot of resistance. So if the UUP decides to pull back, then that'll push the markets higher. So just keep that in mind. But if we can push through all of these things, actually over here would be probably the best resistance point here. So just draw these lines on your chart for the UUP. Most of you guys can see the UUP. This is going to be more significant here. And then if we can break through all of these, then you can pretty much what is that word called? Expect the market to start having a nice pullback. Okay, so but just remember, it's the dollar isn't cent for cent, penny for penny. It's more for a tick for a tick inverse to the markets. Okay. All right, this is a chart of the GLD, which is the ETF that tracks gold. Keith wanted to know about gold stocks. So instead of doing gold stocks, I'm going to do more of the gold ETF, because sometimes gold stocks will actually track gold itself. In any case, to make a long story short, I did have mathematical calculations here before. I never really did gold for a long time, because gold is just a messy chart. I personally wouldn't trade gold myself, not right now at least, but I would definitely be trading the market, which is a little bit more reliable than gold at this time, in my opinion. That doesn't mean you can't trade gold or anything like that. It's just for me myself, I'm staying away from gold for now, and that goes for silver as you know as well. So anyways, I did come up with a calculation just on Friday. which was or yesterday, which was 142.88. But it doesn't line up with anything other than this pivot point over here. So I wouldn't say that it was a solid number to be watching for. But it does look like yeah, 142.88 around there. Could potentially be, due for a bounce around that area. And the only reason why I'm a little bit more bearish than I am bullish as far as the as far as gold goes is and when you look at gold, when you look at this right now, gold's just been going down and down and down. This is definitely in a downtrend, right? We have high, lower highs, lower highs, lower highs. We have lows, we have lower lows, and so on and so forth. And you always want to stay with the trend because in case you're wrong in your technical analysis, the trend will give you that, that little boost, meaning if you're wrong, it won't be wrong too bad. You know what I mean? It won't be like a huge spike. But this is what I see in gold right now. And again, the patterns for me in gold, in the GOD at least, isn't as solid as I would like it to be. So don't, this is water off a duck's back, if you will. It's not a solid analysis, but I'll do the best I can. Right now, what I see is a down move here, and then we have just consolidation. Don't mind the spike here. This was obviously a fake out, right? But it's just a consolidation period. And what I see is a potential that when this 20 moving average comes down and price goes into the 20 moving average, we should see another drop. And this drop could potentially be into the 144.88 before seeing a small bounce. I don't see anything right now telling me that there will be a bounce anytime soon, but again, it's just something that I see. I could be 100% wrong on this simply because the patterns it's just messy. There's no solid pivot points. Okay, I mean, you could consider this a pivot point over here, but it's not a solid one. You know what I mean? We have this down move here. This is a nice pivot point, and this was not a nice pivot point. Why? Because again, I need 3 candles coming down first before it would constitute a pivot point. So technically, this wouldn't be it wouldn't be drawn this way. It would be drawn this way. You see what I mean? Anyways, this here was a nice pivot point, but it's just sloppy, choppy, that kind of thing. So for right now, I would stay away from the GOD as well as stocks, from the GOD. But as I can see from doing normal technical analysis, this is creating some sort of bearish consolidation pattern here. And again, I wouldn't pay too much attention with this one. It looks like just some sort of fake out, and maybe another move down to the 142.88. Who knows? I'm pretty much I made this calculation. I don't know if it's even going to get there. People who's been watching these videos, I'm not sure if you have, but I think this is the first time I've seen you respond to these videos. I'm not quite sure, but in any case, when I make these mathematical calculations, it's not saying that it's going to get there. Just like the 157 or the 154 level for the SPY. I'm not saying it's gonna get there, but what I'm saying is if it does get there and I get some sort of reversal signal, then that's when I take the trade, and that's whether it be for a long position like this, 142.88, or a short position on the SPY. All right, so I'm already into 23 minutes. I don't know if I wanted to talk about anything else. One thing I wanted to talk about is JP Morgan, which is the leader for the finance sector. These are old drawings. There we go. These are my old drawings here. My old calculated levels, 43.41. We had a hit here. We had another hit here. And then the 44.33, we had a nice hit here. And then a gap above that here. So the levels are working out pretty well for JP Morgan. I'm not going to make another level for JP Morgan because I don't plan to trade JP Morgan. But what I do plan to do is kind of monitor JP Morgan, because JP Morgan right now it's just been a workhorse. And what I'm seeing is JP Morgan is right into resistance, probably why it had a small pullback. What I'm seeing is a very, very strong stock. They may actually push JP Morgan all the way up to here, which is about the 53.25 level. Probably around the 53 flat. I'm just going to say 53. You know what? This is what I'm going to do. I'm going to give me some time. I'll be right back. Let me see if I can do this here right now. Nope, the data is just way too skewed right now. This big move here in JP Morgan, this uptrend here, has just been unbelievably crazy. In fact, to be honest, my highest level for JPM is $50.18, and we've already passed that. We're at $50.20. So we could actually start pulling back now or very shortly, but you know, to make a long story short, there's higher highs, there's higher lows. This guy's still in an uptrend, so that's just something to keep in mind. And if JPM is the leader of the finance sector, then you can pretty much bet that if JPM is still strong, the markets are going to probably stay strong as well. But like in any move, and I always talk about this in any video, just because it's been higher highs and higher lows, when it's extended like this, higher high, higher lows, start looking for a pullback. Okay. All right. This is a chart of Apple, which is supposedly the leader for the tech sector. Um, I've done analysis on this video here for Favco, and I had this 476.39 level. We got below that, and then we headed lower, and it went right back into the 476.39 level, making this now resistance, and then boom, we've just been falling since then. And I've said in my previous videos that Apple looks weak, and so far Apple has been weak. Okay, and we've got a bounce. Let me just extend this to the right here. Yeah, we got a bounce right here. Perfect analysis for a non-mathematical calculated level, which was the gap fill here. Okay, as you can see, gap fills. I know some people get confused. I've actually talked to somebody about a gap fill before. In my opinion, a lot of people do their gap fills and gap windows different. But if you had a down day the previous day to actually make this gap here, see that? The gap fill is on the bottom of the candle, right? Because that's where it closed. So it would make sense that the next day it opened up here. I'm sorry, here. So to make a long story short, this on the bottom of the candle would be the gap fill, and that's actually exactly what we got. And then we got a small bounce. But again, you know what? Apple still looks weak, and it's been in this downtrend, and nothing's telling me otherwise. What I would wait for Apple, in my opinion, is simple. We wait for a reversal pattern saying that the trend is going to reverse. How do I know the trend is going to reverse? We close above a pivot point. Okay, and then as we come down, so let's just say as an example, we go all the way up here, we close above that pivot point, we come down here, we close above the bottom here, right, which would make a lower high and a higher high, and then boom, I look for a reversal and I start going long Apple. Okay, that's what I would look for. Anyways, I'm already into 27 minutes. I know I said I was going to make these videos shorter, but there was just a lot to talk about today. I just wanted to show you every angle that I was looking at. And who knows, tomorrow I might actually think about initiating a short trade. We'll see what the pattern looks like. We'll see what the daily, I would have to look at the daily chart. I don't know if I'll be up that early in the morning when the market opens, but that remains to be seen, and we shall see what happens. Maybe the pre-market, I'll pick up some shorts, I don't know. But again, it is semi-contradicting because the intraday chart is showing that there could be a potential continuation to the upside. JPM is still strong, and you know, again, the dollar still does have a lot of resistance in its way, so that dollar could be potentially pulling back as well. So there is contradiction in the trade. Oh, and since I got 2 more minutes before making half an hour, I just want to remind you that the way I trade is like a business. Okay, I try to at least. I'm human, so I'm gonna have emotions. Emotions are gonna affect me because I am human. But there was a movie that I watched previously, and it reminded me about a lot of things. The movie's name was 21. You guys should check it out if you guys didn't see it. It stars, I forget their names, but basically they were, and it reminded me of people telling me that trading the stock market is gambling. You guys can shut down this video now because I'm just going to go on a rant. There's not going to be any analysis involved from here on. But they're saying that counting cards, or playing blackjack in Las Vegas, is still considered gambling. What do you think? I mean, if people say that the stock market is gambling, you tell them, or what I would say is, well, that may be so. However, I mean, it really depends on how you look at it. Everybody knows what counting cards is, right? Everybody has heard of people counting cards and that being considered cheating in playing blackjack, and that's why they ban you or blackball you in the Vegas casino hotels. But is it really cheating? No. All they're doing is using a mathematical calculation in their head, based on certain numbers, will give them the odds and reverse the odds from being in the dealer's favor into the whoever is not the dealer's favor, whatever the name is. What I'm basically saying is this: if I would tell that guy, if you could count cards, would you consider that still gambling? And they would probably be like, no, that's not gambling, that's cheating, because now you have the advantage. But that's exactly what technical analysis is in the markets. We are just using simple mathematical calculations. And let me tell you guys right now, these moving averages, these pivot points and all that, that's all pure mathematical calculations. The Fibonacci retracements, that's mathematical calculations. Everything we look at when we do chart analysis is based on some sort of mathematical calculation done by either somebody else, by yourself. It doesn't matter. When we look at charts, it is it is an equation. And simply put, when you put the odds in your favor, do you think someone who counts cards in blackjack will win all hands? Obviously not. They'll win some and they'll lose some. But majority of the time, because the odds are in their favor, as long as they play long enough, then the odds are that they're gonna make money because the odds are in their favor, right? I mean, if you think about it that way. Now, once you involve emotion in the game, including counting cards and blackjack, once you start playing and you're not using these mathematical calculations anymore, then you're gambling. Okay, at that point, the odds are no longer in your favor, and now you're gambling. In the stock market, you do not want to gamble. You want to gamble? You go to Vegas, because at least over there, you can have a lot more fun. There's a lot more parties and everything and whatnot, and then you can have your 50, your 40, 60 chances of winning. Okay, but in stock market, it's a business. Okay, it's pure business. You have a set of rules, you follow those rules, you protect yourself from manipulation. Just like anything else, we're counting cards. Is counting cards illegal? Absolutely not. But the casinos don't like it because the odds are no longer in their favor when you count cards. So just think of it that way. This is a business. You have a set of rules. You have to absolutely follow these rules. You have your stops in place. You have a number in mind. When that number is hit, whether it be on a close or if it's just hit, it really depends on how you want to play it, then you get out, right? That's what keeps you protected. That's what the game of blackjack basically is. When you count cards, is you have a set of rules, you don't involve emotion, and then you run it like a business. As long as you do that, then it'll be okay. And that was pretty much what I got from watching that movie 21. It was a pretty cool movie. I've seen it before in the past, but it was nice to be reminded of how to, as much as possible, keep the emotions out of your game, treat it like a business, and then, as long as the odds are in your favor, as long as you play enough, in my opinion, you should be coming out on top. Well, that's it for my rant here. It was a pleasure to make this video for you guys. Thank you very much for taking out the time to watch these videos, and obviously thank you very much for hitting those like buttons. I know I don't have very many subscribers or anything like that, but again, it's just one of those things that I love technical analysis so much. I love the stock market so much that I really don't mind releasing my secret calculations to you guys. So obviously you guys can make these trades and beat those institutions that are manipulating the general population, the people with 401ks and all that. So I see us as the Robin Hoods. We take money from them, and if possible, if you are making money off these videos, I'm not asking for any money. These videos have always been free, in my opinion. Obviously I don't make any money off ads or anything like that too, but go out there and do something nice. You don't have to donate money, although that would be nice. Donate some of your money, 10% or whatever. But if you don't want to do that, you don't believe in that kind of stuff, giving back, give back a different way. Hold the door open for somebody. I mean, it's not that hard to do nice things out there. So just do one thing every time you make money off watching these videos. Do one nice thing, something random to some random stranger out there, and that's all I ask. Anyways, have a good day, have a good week, and hopefully I'll see you in the next video.